Who wants to be a millionaire? No, you're not going to become one by watching some TV game show or playing the lottery. But what if I told you there was a tried and true, no BS, no hype way to legitimately become a millionaire in just a few short years? Sound too good to be true? Well, it doesn't have to be. This video, I'm gonna actually show you, I'm gonna break down exactly how to make this happen using math, a crazy cool real estate method, I call it the multifamily millionaire method, and the right mindset. You see, my name is Brandon Turner, and I am a multimillionaire thanks to this exact strategy I'm gonna lay out today for you. I'm also the host of the world's most popular real estate podcast called the BiggerPockets podcast, author of several real estate books, some of the top real estate books in the country, and an author of a couple new books called the Multifamily Millionaire, volume 1 and 2. I co-wrote it with my partner, Brian Murray. And in other words, like, I know what I'm talking about. I don't just talk the talk, I actually walk the walk. And I walk the talk and I talk the walk and whatever. So in celebration of releasing these two new books, which you can get at biggerpockets.com/multifamily book if you're into that kind of thing, I'm gonna be giving you a glimpse into the powerful multifamily millionaire model. This is literally probably the coolest and the best chapter in the new Multifamily Millionaire book, broken down for you because I want this to change lives. Even if you don't read the book, I want this, like this is a chapter that matters so much to me because I think it'll change lives. So it's gonna show you how to potentially create millions of dollars in net worth in a few short years. Now, first, can I get you to do 3 quick things? Number 1, grab a pen and paper. Seriously, this is like school. You're gonna wanna take some notes. Secondly, lovingly tap that subscribe button like below the video if you like real estate or wealth building content. And third, hit that like or the thumbs up button or that heart button or whatever's below the video. It lets people know that it's good. And if you don't like it, then don't do it. But I think you're gonna like this because this video is like gonna change your life. Now I know that sounds like hyperbole, but honestly, had I understood this concept when I got started on my journey towards financial freedom, I'd be worth millions of dollars more. Okay, now to truly understand how this model works, you need to understand the vital difference between how properties are valued. Now, I know, boring, right? Yes, stick out with me for a minute. This is important. The difference occurs when you shift from residential to commercial properties. When I say commercial, I mean like multifamily or commercial, whatever. So in the world of a bank, a single family residence, or maybe a duplex, triplex, fourplex, that's all called residential. For these properties, the value is based on what other similar properties have recently sold for. So like if your neighbor's house sold for, I don't know, $250,000, it makes sense that your house, which is pretty much the same, let's just say, it's gonna be worth about $250,000 as well. Now, maybe your neighbor's house was a little bit nicer, or maybe yours is a little bit nicer. Whoever's nicer might be worth a little bit more. Maybe your neighbor's house has a pool and you don't have one, so now theirs is worth a little bit more. Like in other words, they make little adjustments, but it's based on what we call comps. That makes sense, right? Comparables. Now let's go over why this doesn't work for larger deals like the commercial side. Now imagine for a minute you want to determine how much a small apartment building is actually worth. Now maybe the property has like 15 residential rental units. So it's got 15 little units, some 1 bedrooms, some of them are 2 bedrooms, a couple studios in there, and we'll throw in a few mini storage sheds that they're renting for $50 a month. So in total, let's just say the property brings in 12 grand every single month. That's the gross income is $12,000. That's what it's called. Gross income. It's not gross. It's cool. I can almost guarantee you're not going to find another 15 unit property with the same number of single family or like studios, 1 bedrooms, 2 bedrooms with all that. It's just too diverse. Commercial real estate has too many options out there, so we have to look at properties differently. We can't just compare to other ones. So how would someone determine what a property is worth if there's no properties that are similar to compare it to? Well, how about instead of comparing the property to other properties, which we can't find similar ones, we compare the profit generated by the property to the profit from other properties. I mean, after all, real estate investors are the only ones really buying multifamily properties and big commercial deals. So what they care about is profit, like return. They want to get a good return on their money. Trying to compare your 15 unit property to my 30 unit with totally different rental rates, that would just be silly. But comparing the profit that I make versus that property makes, now that's an apples to apples comparison. So for example, let's go back to the 15 unit. Let's say you made 30 grand in profit this year, and I have a 30 unit property. You have a 15 unit that made 30 grand. I have a 30 unit that made 30 grand in profit as well. Now those seem like the same, right? Both make the same amount of money. So you'd assume they'd be worth about the same, right? Almost. You see, it's not quite enough to just compare the profit. This is important. Let's say you paid $1 million cash for your property, but you have no mortgage payment, no mortgage at all. But I put only 25% down. So let's say $250,000 or whatever, and I got a large mortgage payment. So who's really actually making more profit? Or more accurately, which project is more profitable based on the amount of money we actually invested? I mean, you're making 30 grand a year, but you invested $1 million. I'm making 30 grand a year and I only put in 250 grand. Clearly my deal is pumping out way more profit per dollar invested, because although we're making the same cash flow in terms of like dollar amount, my deal has a large monthly mortgage payment to consider and yours doesn't. Now, if I didn't have that mortgage payment, I'd be making way more than the 30 grand a year, right? Because I'm dumping a lot into that mortgage. So if we wanted to apples and apples, let's clarify this a little bit. I mean, this is seriously going to change your life here in a second. So stick with me. This is the basis of the multifamily millionaire model. You have to understand this point to get everything that follows, which is why I'm spending a lot of time here. It's not super complicated, but if this is your first time walking through it, I know it might take a few minutes to internalize it. You might even have to replay the video a couple times to let it sink in, because I know I talk a little fast. All right, once you get this though, your life will never be the same. You're gonna love this. So we know the following facts about our examples here that we're talking through. Each of us is making 30 grand a year in cash flow on our deals. But you invested $1 million to get that 30 grand. I invested only $250,000 in a down payment to get the same amount of cash flow. So how can somebody trying to determine the value of a property and trying to compare apples to apples, how do you compare my deal to your deal? It's simple. We ignore the mortgage, because that's a variable that changes with everyone. Some people put 5% down, some 50% down, some 100% down. So we just ignore the mortgage. We leave it out. Think about it. If you had no mortgage, so your deal stays the same. You're making 30 grand in profit after all your bills have been paid. Now let's say, assume my property, my mortgage payment was $100,000 a year. That's what I was dishing out, 100 grand every year. So although I'm clearing 30,000 in cash flow, just like you, if we ignore my mortgage payment, I'm actually making $130,000 a year. I simply add back in the mortgage payment, the principal and interest, not the taxes and insurance, just principal and interest, which is 100 grand a year, to my 30, and I'm at 130. Now this amount of money, $130,000 for me and 30 for you, now that's essentially the cash flow, not including the mortgage. Now we're apples to apples. Another way of looking at this is, how much money do you have left to pay the mortgage? Like, regardless of whether you have a mortgage, how much do you have left? That metric, that amount we're talking about, is a very, very important term. It's called net operating income. Super important when it comes to commercial real estate, multifamily. It's net operating income. It's imperative you understand it. The basic definition of net operating income is the profit you get, not counting the mortgage payment. So written out like a formula, if you want a formula person, if you're a formula person, looks like this. NOI, net operating income, equals the gross revenue, all the money that comes in, minus the operating expenses, all of the money that goes out, not counting the mortgage. Taxes that would be included in operating expenses, insurance is in there, repairing a broken toilet, whatever. Like all those kind of expenses, we pull, that's operating expenses. So what we're left with is how much money is left to pay the mortgage, if we have one. That's NOI. Here is where things start to get fun, with the introduction and the breakdown of a cap rate. Now, you may have heard that term before. Let me break it down for you. An appraiser can now look at the amount of money you paid for your deal. Let's say you paid $1 million, and they can say, okay, they paid $1 million for the property, and it's making them $30,000 in net operating income, in profit, basically before the mortgage. But there's no mortgage, right? We're ignoring that. So you're receiving a 3% return on that money, because 30,000 divided by $1 million is 3%. Now wait, where'd they get that from? Well, think about it this way. If you invested $100 in something and you made $10 in profit, that's a 10% return. That's all we're doing here. We're saying, like, in math formula terms, it's like total profit divided by the total investment, and that's your return on investment. Now, for the purpose of evaluating a commercial real estate deal, we want to see the return that different deals produce on paper. We're going to slightly modify the above return on an investment calculation to get us to the finish line. We're simply going to ask ourselves how much profit we made compared to how much we paid for the property. Do you see where we're going with this? How much profit did our NOI divided how much we paid for it? I mean, since we're ignoring the mortgage, the price we paid for the property, we're basically saying is the total investment. That's not always completely accurate, because there might be closing costs and some repairs and stuff, but we'll just say it's the investment. We'll assume it's the same thing. Your property's profit, its NOI, is 30 grand. We already covered that. And you paid $1 million for the property. So again, the formula looks like $30,000 divided by 1 million equals 3%. Now that 3%, that is called the cap rate. You probably heard the term before. The initial breakdown, like this whole thing has been an attempt to explain the theory and reasoning behind what a cap rate is and why it matters. So a cap rate is the rate of return an investor would buy a property at, not counting the mortgage. The cap rate is a number that really represents like risk for an investor. That's the return they're going to get if they didn't have a mortgage. Like that's it's a basis of risk. So if a property is really risky, you're going to want a higher return. If you're going to toss your money into an investment that has very little chance of paying you back, you probably wouldn't choose one that best case you're going to make 3% on. You'd probably just put your money into a savings account or the stock market, right? So if you're going to go into a high risk investment, you're going to want a higher return or a higher cap rate. Now, conversely, the lower the risk, the lower the cap rate. Now, it's for this reason why super nice properties in like A-class neighborhoods, really nice properties in nice areas, they usually sell for really low cap rates, really low percentages. Like, in fact, some markets are below 3%, some below 2%. It's crazy. A nasty fixer-upper in like a rough area, that might sell for a cap rate of 10% or more because investors want a higher return on that. Now, the official calculation for cap rate, the calculation is NOI divided by the property value. That's the cap rate. Now, so commit that to memory. Like, pin it on your wall, tattoo it on your forehead, backwards, of course, so you can see it in the mirror. This is so important. This is one of the most powerful formulas in all of real estate, and it will make you a millionaire many times over if you work it right. But more on that formula in a minute. We're going to actually play with that formula a little bit, and we're going to spend some more time on it. But first, so we've determined that you bought this property at a 3% cap rate. That's the number you, a normal real estate investor, was willing to buy the property at. Now let's talk about my property. Now, my profit was also 30 grand. Remember, we're going to ignore the mortgage. We're going to add it back in. So my NOI, the profit I had left to pay the mortgage, was $130,000. So what did I buy my hypothetical property at? For the sake of this example, let's just say we bought my property for $3.7 million. So math time, quiz time, right? Let me write this down. If my NOI was 130,000, and I bought the property for $3.7 million, what cap rate did I pay? Let's do it together. So we're gonna round the final numbers to 3 decimal places, but basically 130,000 divided by 3,700,000 equals 3.5%. I was able to buy my property at a 3.5 cap rate. Now here's the big deal and what we've been building toward. To determine the value of a single family house, like we talked about earlier, you compare it to what other similar properties have sold for. But to determine the value of a commercial real estate, like any multifamily property with 5 units or more, you're gonna compare it to what other properties of a similar asset type in similar condition with similar cap rates in similar areas have sold for. We can compare the 15-unit apartment with the 30-unit apartment. Even though the rents are totally different, how does that cap rate make you millions of dollars? I mean, after all, you're not watching this video so you can be the best commercial real estate appraiser around. I mean, now you got a pretty good understanding of how to appraise a commercial property. So how do we use this? You want to use this to create some personal wealth. Let's start by tying it all together. Here's that formula again for determining the cap rate that we looked at earlier, and that is NOI divided by property value equals cap rate. Now, if you remember like algebra from like 8th grade, this formula could be also written as property value equals NOI divided by cap rate. I mean, all 3 of those formulas tell the same story. If you just kind of move them around. If you know 2 of the variables, you can always solve for the 3rd. For example, let's say there's a 15-unit apartment complex for sale and you want to buy it. So based on the discussion you've had with your broker, you know the average cap rate in the area, like most people are paying around a 5% cap rate. You also know the NOI of that property. Let's just say it's 40 grand because that's actually in the marketing material. So now we know 2 of the variables, right? We know cap rate, we know NOI. So we can solve for the 3rd. Well, let's do that. Remember I said NOI divided by cap rate equals property value. So $40,000 NOI divided by the normal cap rate in the area of 0.05 or 5%, that's $800,000. So that property should be selling around $800,000 because this is probably the same methodology the seller's using to price their property. I say probably because, I mean, let's be honest. Sometimes just people list their properties at whatever price they want to. Or maybe they needs a ton of work. Maybe they know that it's worth way more, but it just needs some fixing up. So they're going to price it to reflect all that. But at least keep in mind, like that should be about what it's worth. Now, keep in mind, the property value is based on where the NOI is at today. Now, since you're a savvy real estate investor, you want to know what the NOI will be once you own it. So what if you could improve the NOI? How would that impact the property value? This is where things get even more fun. Let's make some assumptions as to what exactly makes up that net operating income. Remember, revenue, like your gross revenue minus your operating expenses equals the NOI. So let's say your revenue was $100,000. That's how much total came in on your property, $100,000. Your operating expenses are, we'll say $60,000. This is, 60 grand. So that leaves you with a $40,000 NOI. Now, let's say that the income was way lower than it should have been because the current owner hasn't raised rents in 10 years. So after buying the property, you raise the rent by, we'll call it $50 a month. Now, with 15 units in the property, that's an additional $750 every month in total extra income. That works out to an extra $9,000 every year in income because $750,000 a month, $750 a month times 12 months equals $9,000. Let's also assume that during this time, you were able to reduce the property's operating expenses. So maybe you put in LED lighting or you renegotiated the cost of garbage or property management fees or whatever. And so you're saving now like $500 a month. So that's an additional $6,000 in your pocket. So within no time, your revenue went from 100,000 up to 109, and your operating expenses went from 60 down to 54. So using the same calculation for NOI, we can see that 109 minus 54 equals now $55,000. So just by raising the rent slightly and reducing expenses a little bit, you've increased the NOI by $15,000 a year. Now, maybe you don't think that's a big deal. You know, what's $15,000 a year going to do for your life? Well, let's find out what happens when we take that new NOI, the $55,000, and we plug it into our formula. So now NOI divided by cap rate equals property value. So 55,000 divided by a 5 cap is 1.1 million. Now, wait a minute. Did I just raise the value of that apartment by like 300 grand from 8 to 1.1 by just slightly increasing the rent and slightly decreasing the expenses? Yes, that's exactly what we just did. That's the math. That is the multifamily millionaire model. And it's super powerful. And this can be done in like a short amount of time. Let me repeat that. That's 300 grand in 12 months. We've just added massive value to the property. You've built immense wealth for yourself and future generations from one deal. And that's only the beginning, because over time, what's going to happen to rents? They're going to rise even higher. Now that loan gets paid down a little more every single month. Plus you get monthly cash flow coming in every single month that you're like basically paying almost no taxes on, because of the US government's very friendly to Americans who own real estate. It's like a win-win-win-win-win. It's a ton of wins. And this is just, again, the beginning. It's a tip of the iceberg. As the deals get larger, now you're adding more units and more income, and the profit continues to scale. In fact, I'll give you an example. One of my deals I bought about a year and a half ago, 18 months ago, with my company, Open Door Capital. So we buy big properties. We recently bought multifamily property, we paid $2.9 million for it. And we increased the income a little bit, not even raised the rent much. We just a little bit. We just managed better. We decreased vacancy. And I've added almost $1 million of net worth to my own life just from one deal. I mean, this is amazing. Now imagine buying a $5 million property and turn it into an $8 million, or a $50 million property and turn it into an $80 million. I mean, I just bought a $57 million property, and we're going to do some amazing things and turn that into way more valuable. And I get a piece of that. I mean, this is all doable, and you can do it. And that's what the whole book that I wrote, the Multifamily Millionaire Volume 1 and Volume 2, both those books go into this way more detail. Volume 1's all about how to get started with like smaller deals, duplexes, triplexes, stuff like that. It's perfect for anyone just starting out with they don't have a lot of experience, not a lot of money. Start with Volume 1. And then Volume 2 focuses on how you're going to turn those skills that you learned in Volume 1 into a huge portfolio to take down massive properties, to raise money, syndications, all that stuff, so you can become exceptionally wealthy. Like, it really ramps up. Now, if you enjoyed this video and you want to become a multifamily millionaire, help me help you by picking up a copy of those books, The Multifamily Millionaires Volume 1 and 2 at biggerpockets.com/multifamilybook. And that's it. Time to start the video over again, because I know you're going to want to watch it again, because I know there's a lot in here to unpack. But if you can just get this concept and you realize the power of what we call value add real estate. And hey, if you have any questions at all, if you're confused and you watch this a couple times, you're like, I don't get it, put a comment below. I'm here to help you. I want to help you become a multifamily millionaire. Now, for BiggerPockets.com, my name is Brandon Turner, signing off.